Good afternoon and welcome to our Financial Advisor Forum this Tuesday, November 5th. I'm Greg Greenberg from The Street. Now, if you bought a low-cost index ETF like the SPY at the start of the year and simply held it, you'd be doing pretty well, up around 25%. That said, my next guest says you could be doing a whole lot better if you ignore buy and hold and use a tactical approach. Nick Atkeson, author of Win by Not Losing, is here to tell us all about it. Welcome, Nick.
Hello.
All right, so once again, if you bought the S&P at the start of the year, held it till now, you'd be doing pretty well. What's wrong with buy and hold?
Nothing. Buy and hold's great during buy and hold times, but sometimes the market isn't a buy and hold time. Sometimes it drops dramatically, like in 2008, 2009. So our tactical approach kept you in the market all this year, but the key is it kept you out of the market in 2008. So in 2008, the market goes down 37%. Our worst performance was 1.79.
And how do you do it? By measuring sentiment? Is that the trick?
That's exactly right. We have a number of ways of measuring sentiment, which is basically people's willingness to accept risk. If they're becoming risk averse, you don't want to own risk assets. And if they're becoming risk seeking, you do want to own risk assets.
So in the book, you say that the market is not efficient. And over the long run, I'm pretty sure it is. Tell me why you think it's not.
Okay, so we've looked at the market over the last 140 years. And it turns out, looking at a longer time frame, you can see that the market is actually somewhat trend following. It stair steps higher in big chunks of time. For example, 1965 to 1982, the market didn't rise at all. 1982 to the year 2000, we had a big bull market. 2000 to 2012, we have this sideways, choppy, volatile market. So what we're saying is that this is somewhat predictable. You can use market sentiment to predict it, and you can trade through long periods of choppy sideways market activity and make money.
Well, certainly there are bubbles, but market timing is really tough. Can you give me the nuts and bolts of how you do it?
So in Win by Not Losing, we lay out a simple sort of cookbook style methodology of figuring out when to be in the market and when to be out, to identify bullish trends and avoid bearish trends. And we use a simple moving average crossover model that's explained in the book. We also have a newsletter that ties to it, gives you weekly current updates as to what's going on with the sentiment indicator. But it's a fairly simple model. You can actually put it on your PC at home and back test it to the extent you want. No need to really back test it. We have proven real money strategies that have demonstrated great audited performance. But again, it's a simple moving average crossover.
And where are we right now? Should I be in or out? And what should I be in if I'm supposed to be in?
Okay, so great question. You should be in. But like anything, you should also be maybe in a home. You should be in your health and fitness. And in other words, whatever it is you're investing a lot of your assets into, you might want to have an insurance program. And Win by Not Losing is all about putting money into the market, but having an insurance program that in case the market enters a bear phase, which it could, that you're protected, that you have some disciplined methodology, some systematic way of getting out.
What is the insurance then? Is it sell everything when the indicator turns the other way, or is it sell call options? Is it put limit orders? What's the insurance policy?
It's the best insurance policy in the world. It's don't be involved when things go badly. In other words, get out of all your equities. In 2008, 2009, it didn't make a difference if you owned Exxon or Inktomi or Baidu. They all went down. So in times of crisis, the key is not to be holding assets that are under great stress.
And then finally, the fees aren't onerous if you're in and you're out?
The fees for trading are very light. Now we have very efficient markets in that way. We have ETFs, and we have very effective mutual funds that can be traded to trade large baskets of stock cheaply. And the fees on the overall strategies that we offer in Win by Not Losing and in our management business, Delta Investment Management, is very low, within the normal bounds of actively managed mutual funds.
And you don't have to be watching the computer every single day to wait for that turn in the market.
Yeah, we're not talking about day trading. We're talking about sort of trend trading, being involved in major up moves, being out of major down moves. So maybe 3 trades a year.
All right, Win by Not Losing. Thanks a lot, Nick.
Thank you.
And thank you for watching Financial Advisor Forum on the Street. I'm Greg Greenberg. Thanks for watching.